Welcome back, and let's get to that promised conversation with the experts at JPMorgan, the rise and rise in block trades. So the deal street has really been buzzing. And in a minute, we'll just have Abhinav Bharti, Managing Director and Head of India ECM at JPMorgan, joining in. But first, the number. And the number is really important to note. I mean, look at the pace of activity. It's frenetic activity. 14 billion was the whole value of block trades in the previous calendar year, 23. And in 24 so far, we have already crossed 10 billion. And the last 6 months, obviously, have been extremely hectic with that number of 12.5 billion, which is on your screen. So, as promised, let's try and understand what all of this signifies and what lies ahead. We do have Abhinav Bharti, Managing Director and Head of India ECM at JPMorgan, to take some questions. Abhinav, great to have you on the show. Thank you so much for joining in. So, I suppose you've been really busy over the last couple of months going by those stats.
Indeed, it's been possibly one of the busiest times that I've ever seen in my experience or the time that I've spent in capital markets. There is certainly a lot of excitement about India at this point in time amongst both global and domestic investors.
Sure. So, Abhinav, at the secondary market level, we've been debating this for a while and asking a lot of market participants what it signifies. This rise in blocks and a lot of the exits, these are intelligent investors, so to speak, that are exiting, whether it's PE, early stage PE, or MNC promoters or Indian promoters. What does it signify? Does it signify a maturing market, or does it signify some sort of a top with respect to valuations?
No, I think, look, each of the different classes of potential sellers have different reasons or rationale as to why they have to undertake this. If you really look at it this year, the largest parts of or segments of selling has come from either MNC clients or private equity clients. And from whatever we hear, at least from the private equity clients, India has been one market where they're able to show monetizations, which as part of their requirements for their LPs is something that they need to do. It's an only market where liquidity has been available at decent valuations, and therefore, to that extent, block trade activity has been at a heightened level. At the same time, there are no alarm bells in my mind because they're equally raising larger and larger funds, which are focused on deploying into India or have a significant allocation towards India. So it's a cycle that is actually, I would argue, is getting played out in a manner in which it is supposed to be. There's recirculation of capital properly in the ecosystem. When it comes to MNCs, what we are seeing is or noticing is that it is what I would call it as active portfolio management from their perspective. It is corporate finance 101 that if you need to if you have cheap stock available or to buy back for the parent, you would essentially look at raising capital from your subsidiaries where valuations are quite decent, which invariably happens to be in India, which generally has a further premium for MNCs. And we are seeing some of that happening. But again, I would argue that given the fact that some of these MNCs have started to evaluate doing IPOs for their subsidiaries in India, there's no lack of commitment towards their Indian operations at this point in time.
Abhinav, morning. Can you talk to us about the pipeline and how might H2 look vis-a-vis H1? Is it going to be as robust? And was election, even a consideration in the closure of deals?
It is. Election is certainly a big factor. In fact, if I may give you some numbers, 2021 was the previous high when it came to IPOs. We had raised about $16 to $17 billion in IPOs that year. Average deal sizes was about $400 million. Since then, the average deal sizes are more, or for IPOs are somewhere between $200 to $250 million in that zip code. The pipeline that we are seeing currently at this point in time for us as well as for the market as a whole is closer to $20 billion of mandated pipeline, and there is more that we expect to get mandated to banks in the next few months. And in likelihood, the average deal sizes will start moving towards at $400 to $500 million on average mark, some of them actually topping $1 billion as well. That clearly shows that, number one, the momentum on this side is quite high. Equally, at the same time, the election part of what you raised is the key reason why a lot of issuers have waited for bringing their larger size capital raises post-election, and you would start seeing them hitting the market. Mm-hmm. But yes, given the pipeline, very likely that this could be a year where I wouldn't be surprised if we eclipse the 2021 high IPO capital raise. Forget about the total capital, that certainly will be the case. But even for IPOs, we may actually eclipse the 2021 number.
Abhinav, the 20 billion pipeline number that you just spoke about, that's for secondary block trades, exits, or is it also, does it also include primary fundraise?
This is only primary fundraise for through IPOs.
Okay, so primary
and others is all on top.
Oh, okay. So primary fundraise alone, IPOs alone is 20 billion, and then over and above block trades. On block trades, I mean, what do you expect on the intensity? Will it remain as high as what we have seen? And also, what about the absorption power? I mean, I'm guessing a lot of the buyers are domestic institutions, domestic mutual funds, right? What's the sense you get from that side, given the retail flows?
So some of the larger ones have already taken place or got executed in the first half of the year. My sense is the activity will remain high. These may be, not necessarily very large block trades that happen. I think the second half of the year, in our view, could well be driven, like I said, by IPOs. But the run rate for block trades could still be pretty high. In terms of, sorry, what was your second question, Surabhi, if I may just ask again?
In terms of the absorption from domestic institutions, mutual fund investors,
yes.
Sort of whether that you expect that to remain as healthy as it has been.
Nothing as of now gives us reason to believe it otherwise, because if you really look at the inflows that are coming into the market, and we should not just think of it only from mutual funds, because in my view, the inflows into the market, at least from the domestic side, is a much broader set. So we talk about SIPs, which get the most amount of attention in the media, but the discretionary flows into the mutual funds, the direct flows through retail, and then other pockets like pension funds, AIFs is all on top. My sense is that the number from this set is possibly equal to what the SIP flows at this point in time are. So from that perspective, the inflows into the mutual funds or coming from the domestic savings ecosystem will remain high. I also believe that I think once the election outcome is in place and the event risk is out of the way, very likely the FII part of the equation, which has generally been a lot slower this year. In fact, at this point in time, year to date, they are pretty much flattish to slightly negative when it comes to flows into the country. I think that part could also start turning the wheels in the right moment.
Getting back to that mandated pipeline of $20 billion for primary fundraise, Abhinav, could you share some names? Because, for instance, Oyo IPO has been delayed. There is Swiggy, which is, announced, filed its DRHP for an IPO. So they're looking to raise some money. So what are the big ones that we should expect, where perhaps in the next 12 months? And what's the appetite now for these new age companies?
Yes. So look, the new age companies' appetite has certainly improved quite substantially, because if you look at the listed cohort, which is out there in the market, that has all done very well. And it has done well, not just because the flows have been good, but because the operating performance for companies has really improved dramatically. I'm talking about like Zomato, Policy Bazaar, and others. So to that extent, that has really increased the appetite for investors to evaluate stories in the consumer tech space of the new age cohort. This is a segment which is quite underrepresented in the Indian context. I mean, the market cap would be, I would say, sub 2% for this cohort versus generally 20% plus when you look at US or China or other larger markets. So there's a long runway for these companies to actually approach the market and be part of the listed ecosystem, and investors having them as part of their portfolios. The other thematic, of course, continues to remain that anything which is on the domestic consumption thematic or theme, so consumer retail, all of those sectors are the ones that are really driving or are going to be the sectors where we are starting to see IPOs coming to the market. I believe manufacturing is the other sector which is starting to see some green shoots around, starting to come to the public markets as well. So this year we will, in my view, start seeing some of the manufacturing companies also approaching markets and raise capital, which I think will be a good sign that they are able to raise capital from public markets.
Okay, interesting. So consumer, perhaps manufacturing, that's where we're going to see more of the action. Abhinav, what about the asking rate, the valuations? Because I think, 21, 22 were very interesting years because you You could be loss-making, but the market was willing to ascribe a lot of value at the IPO time. Then the market beat down these businesses, and now the whole path to profitability has happened. So when you talk about some of the newer age businesses, not just internet, tell us, I mean, I don't know if people in the EV ecosystem, whether they're looking to come to the market right now. EV is the next hot buzzword, right? So any new businesses, non-traditional businesses, what's the chatter on valuations and profitability?
So number one, the market has primarily moved towards now profitability-based metrics. So investors are focusing on EV/EBITDA, price to earnings, growth-adjusted multiples. Whereas in 2021, a lot of these discussions used to be on revenue multiples. And fundamentally, I would argue that it's a much more balanced approach to arguing valuations between investors and issuers when it is on profitability-based metrics, which is now the case. And I think it just bodes well. What I am seeing certainly is that given that there is a longer visibility of growth for most sectors in India, including the consumer tech or new age names, investors are willing to look a little bit forward when it comes to these multiples. So instead of, let's say, focusing on just 1 year forward price to earnings or EV/EBITDA multiples, a lot of investors are willing to give the benefit of doubt to companies to even look at FY26 at this point in time, which is effectively a 2 year forward multiple. And that really helps in terms of finding that balance.
Oops. I think we've just lost that feed, but that's a really interesting point that Abhinav was making, that, well, at least the market's a great teacher, they say. So at least we've moved from price to sales to price to earnings, or price to, EBITDA, EV to EBITDA, those kind of valuation multiples, where there is an E in the equation that's not entirely forgotten. Abhinav, I'm not sure if you can hear me, but if you can, great speaking with you. Thank you so much for joining in and enlightening us with some of those views. Thank you very much. You have a good day, and we look forward to another conversation soon. Thank you. With that, let's take a quick break. We'll come back on the other side. For a quick note for our viewers before we take that break, a daily wrap of the top headlines will hit your inboxes before you call it a night with CNBC TV18's daily newsletter on LinkedIn, featuring the top 10 stories on markets, corporate updates, economic insights, and financial highlights. So subscribe now and get the CNBC TV18 edge.